good to have you join us today. Hello and welcome to Business Daily. I'm Lee Ji-yoon in Seoul. We have a lot lined up for you today, so let's get started with the day's highlights. Interest rates are turning negative around the world with hopes of spurring growth. Is it time for Korea to take action? We'll sit down with an expert to talk about this. Koreans' love for foreign cars, especially for Volkswagen models, seems to be growing thanks to big discounts, despite the vicious VW emission scandal that tainted the carmaker's reputation. But first, facing sluggish exports and weak domestic demand, the Korean government has announced a set of new measures to prop up the ailing economy. Our Hwang Ji-hye starts us off.
Korea will front-load roughly $5 billion more of its budget in the first quarter of this year. The government expects the extra injection to boost the country's growth rate by 0.2 percentage points over the corresponding period. The amount of state funds set aside to support local companies will also be raised.
We plan to pour in an additional $12.5 billion in policy financing in the first quarter, focusing especially on helping local exporters.
And that will put the total amount of increased fiscal spending to shore up the economy during the first quarter at more than $17 billion. The measures laid out during an economy-related ministers' meeting on Wednesday come as exports continue to lose steam. The country's traditional growth engine dropped by its biggest margin in over 6 years last month, posting its 13th straight month of decline. To boost spending, the government will also extend a tax cut for automobile purchases to June, originally set to expire last year. Some experts are concerned that spending could flatline early this year as domestic consumption late last year was driven up by temporary government-led sales events. Another package of stimulus measures is set to be introduced later this month, with a focus on boosting investment and removing excessive regulations to spur job creation in new markets. Hwang Ji-hye, Business Daily.
Countries that depend a lot on exports for growth, including Korea, have taken a hit from the continued fall in oil prices. And the Korean government is looking to launch new initiatives to counter the trend. Our Kim Ji-yeon has this report.
The Trade Ministry says it will expand the number of times it sends trade delegations around the world, from 73 to 109 in the first half of the year. In particular, the ministry says it is hoping to engage new trading partners, such as Cuba, and strengthen existing relationships, such as with Iran, by helping Korean exporters build new distribution chains in the target countries. The ministry says it will also work on boosting exports to China, Korea's biggest trading partner, by helping local exporters advance into China's consumer market. In order to do that, the ministry plans to increase research and development of Korean cosmetics and medical products while boosting shipments of agricultural and marine products. It will also establish an $82.4 million development fund to promote Korean cultural content and build a cultural content center in Beijing. To maximize its free trade agreement with China, the Trade Ministry says it will launch a series of trade events throughout the year. The ministry plans to give Korean products that are sold online a mark to certify the quality of the products for foreign consumers. Trade Minister Chu Young-hwan said the country's export decline is due to falling global oil prices and the slowdown in global economic growth. Korea's exports in January dropped 18.5% from the previous month, the biggest plunge in nearly 6.5 years. Kim Ji-yeon, Business Daily.
Korea's foreign exchange reserves dropped for the third consecutive month in January. The Bank of Korea says the country's FX reserves amounted to just over $367 billion as of the end of last month, down $670 million from the previous month. The central bank attributes the downturn to a decline in the value of non-US dollar assets amid the strengthening of the greenback. But it added that earnings generated by managing the foreign reserves increased last month. As of December, Korea was the 7th largest holder of foreign reserves in the world. Monetary easing is already taking on new fervor this year. From China to Europe to Japan, central banks are injecting money or keeping low interest rates to help stimulate their economies. And what about Korea? Our Eunice Kim takes a look.
Following its announcement last month that growth had slowed to a quarter-century low last year, China quickly followed up with plans to release more than $200 billion of its currency into financial markets. 2 days later, the European Central Bank kept its record-low deposit rate of minus 0.3%, while hinting at possible fresh stimulus at its March meeting.
As we start the new year, downside risks have increased again amid heightened uncertainty about emerging market economies' growth prospects.
Last week, the U.S. Federal Reserve opted to keep its benchmark interest rate unchanged. 2 days later, in a surprise move, the Bank of Japan adopted negative interest rates, unprecedented for the central bank, as it committed to revive its economy.
The Bank of Japan is ready to keep a negative interest rate policy if it means we can achieve our inflation target of 2% with stability.
Hit with a double whammy of slowing exports and a stagnant domestic economy, Korea is feeling the weight of stimulus-driven policies from other countries. Korean companies say they felt the January economy was the worst in nearly 7 years, shortly after the global financial crisis. And a further weakening yen under the BOJ's new rate policy could place even heavier pressure on Korea's exports, already in a deep slump. But hasty stimulus could only serve as poison in the form of household and corporate debt, without the intended economic revival. The Bank of Korea has kept its interest rate at its lowest 1.5% for 7 straight months. All eyes will be on its upcoming policy meeting in 2 weeks as more of its peers race to the bottom. Eunice Kim, Business Daily.
And to tell us more about this, Professor Kim Seungwoo from Ewha Women's University joins us in the studio today. So good to see you, Professor.
Pleasure to you.
All right, so we've heard a lot about negative rates, but what are they and how do they work?
The negative rate that we are talking about in Japan is nominal interest rate, which is not adjusted for inflation. But it is not the Japanese civilians' savings account interest rate, but it is interest rate imposed on Japanese commercial banks' accounts in Central Bank or Bank of Japan.
So aside from Japan, more major economies are pushing down their interest rates. Why?
Well, according to basic Econ 101 class, lower interest rate increases consumption of the nation and investment of the nation. And in addition, we have depreciation of the domestic currencies. So that increases export further. So in total, that increases GDP of the nation. And that's the typical way of getting out of the recession quickly.
So seeing all these major economies kind of jumping in on the bandwagon to, I guess, push down their interest rates, does this indicate how hard it is to stimulate economic growth and also, I guess, ease deflation concerns?
Right. After 2008's global economic crisis, we saw 2 stages of expansionary monetary policy. The first was, as we know, a quantitative easing, almost 0% interest rate with unlimited supply of the money. But that didn't work. So second stage, stronger stage of the expansionary monetary policy is negative rates. So that is something unprecedented and very strong expansionary monetary policy.
Now, going back to Japan, do you think the BOJ's latest decision indicates that Abenomics is not working anymore?
Right. That might be true or not, but we have to pay attention to outcomes of the Abenomics in the future. But Abenomics is a combination of 3 policies. The first is expansionary monetary policy. The second is expansionary fiscal policy. And the last is structural reform of Japanese economy. But as of now, the only option of Japanese government is expansionary policy, because the second policy of the fiscal policy does not work because they are sitting on one of the largest government debt, and structural reform takes a long time. But as the negative rate goes on, it doesn't look that will work out in Japan.
Now, I hear that there are mixed evaluations over the effectiveness of the negative interest rates.
Well, European central banks, including European Central Bank and Switzerland Central Bank, started their negative rate policy in 2014. But for the case of the Switzerland Central Bank, that worked for depreciating domestic currency of the Swiss franc. But for the case of the European Central Bank, they wanted to increase the consumption and investment of the region, but that did not work. So result is kind of fixed.
All right, well, I think this adds more pressure onto Korea, considering that its neighbors, China and Japan, have also been pumping out more money to, I guess, shore up their lackluster economy. So where does Korea stand right now?
Well, for Bank of Korea and Korean government, it is hard to decrease interest rate further because there are something limit. The first is there is a high possibility of the increasing household debt and corporation debt, as we have seen in the last year.
Right.
And in addition to that, Korean exporting companies will be suffering from a depreciated interest rate too.
All right, then what other consequences would we see if Korea does decide to join and jump in the bandwagon and push down its interest rates as well?
Well, I think in this kind of shaky situation of the global financial market and economy, we have to pay more attention to fundamentals of the Korean economy, like the size of the foreign reserve, solid economic growth, more flexible labor market, and so on.
All right, then what are your thoughts on this negative interest rate policy, I guess, spreading all around the world right now?
Well, even though negative interest rate is spread out between European continent and Japan, I don't believe that will work out because we are caught by which is called liquidity trap. The lower interest rate and more money supply does not work anymore without structural reform.
So you don't think it'll work in Korea? No. All right. Thank you so much for your insight today, Professor.
Thank you very much.
The commercial operation of Korea's first magnetic levitation train has launched on Wednesday, a decade after the government secured homegrown production technology. The train was developed by Hyundai Rotem, the train-making arm of Hyundai Motor Group. With this, Korea has become the world's second country to launch a magnetic levitation train that runs across the city, following Japan. The unmanned train uses magnetic fields to glide above the rails, significantly reducing friction, and runs at a speed of up to 110 kilometers per hour. The new train will run on a 6.1-kilometer route linking Incheon International Airport with 5 other stations. It's open to all passengers and is free of charge. Nearly 21 million cars are registered in Korea as of the end of last year. This means almost 1 in 2 people own a car in this country. But it's not domestic, but foreign cars that are picking up in demand, especially one particular brand that has been at the center of attention. Our Lee Ju-young tells us more.
Volkswagen's Golf and Passat sedans, as well as the Tiguan SUV, have been some of the company's most popular car models so far in Korea. And they still are, even after the German automaker's emission scandal sent shockwaves across the world. According to Korea Automobile Importers and Distributors Association, Volkswagen sold some 35,700 cars last year in Korea, up around 16.5% on year. This is attributed to aggressive marketing efforts rolled out by VW, which include steep discounts of up to $15,600 for certain models and an extended 60-month installment payment option that comes interest-free. As a result, the company's November sales shot up by 377% on month, selling over 4,500 units. This is in stark contrast with other markets like the US, China, and Japan, where sales have plunged. But it wasn't just Volkswagen that did well in Korea last year. The association says the overall import car market saw sales surge by 24.2% compared to the year before, selling a record 243,900 automobiles. That gives foreign cars over 15% of the local market share, further threatening the footing of domestic automakers like Hyundai and Kia Motors. Experts say the image people have of foreign cars, usually equating them with high quality and safety, won't go away anytime soon. And with global oil prices sitting at record low levels, market watchers add that many car buyers think it's either now or never to nab an import car for a bargain. Lee Ju-young, Business Daily.
And that wraps it up for today. But we'll be back tomorrow with more business news that matters to you, so don't forget to tune in then. Thanks for watching, and goodbye for now.